2019 has kicked off with a partial recovery in equity markets and some solid jobs data, but growing headwinds from overseas and even calls for RBA rate cuts. A quick update on January's highlights and some suggestions for the new year. The stock market falls that started in earnest in October accelerated into Christmas as trade tensions grew and evidence of stress in the global economy became more compelling. So by year end, it was a 15% peak to trough decline for our stock index, but over 20% for US indices, so officially a bear market. The recovery since then has clawed back just over half these losses, so January was a welcome upswing. But the drivers of the bear market haven't changed. Lower global growth forecasts, rising US interest rates, and uncertainty in Europe and the UK with Brexit. The primary cause of the slowdown in global growth can be attributed to US trade policy, and we'll get more news on progress or otherwise in the US-Chinese trade talks over the coming days. But the impact of the tariffs hasn't just been on Chinese growth, which has slowed officially to 6.5%, coincidentally the target growth number set last March, but also on growth in Europe, Japan, and emerging markets. In Europe in particular, economic data has been poor across the board, with the economies of Germany, Sweden, Switzerland, and Italy all contracting in the third quarter. And Japan has also suffered as a result of the trade tensions. As for the US, well, the government shutdown has ended for now, and the US growth rate is close to 3%, but fears of a slowdown in 2019 have fed officials talking about a pause to the US rate rises, and US corporate earnings are showing signs of stress, especially those exposed to China. Here, the strong jobs market has been the consistent positive theme, with unemployment back down to 5% in December, and the Reserve Bank would be very pleased that the Aussie dollar remains well below 74 cents. But there is conjecture that the RBA may need to ease official interest rates again after further falls to property prices and credit growth, and a sharp fall in business confidence, not helped by the headwinds from overseas. Consumer and business confidence often struggle ahead of federal elections, so we'll see how conditions trend before and after May. But the suggestion of an RBA cut is perplexing. We haven't been through a recent tightening in monetary policy, but we have been through a housing credit lending standards tightening, initiated in 2014 by the regulator and then amplified by the recent Royal Commission. So perhaps we need an easing in credit constraints rather than an easing in monetary policy. In the next few weeks, we'll see where inflation prints for the December quarter and if there's any change to the RBA messaging through their statement on monetary policy. But for now, a cautious approach to the market seems sensible given recent volatility and the range of known unknowns ahead. And that's the market update from Bendigo Bank.